Imagine a world where the very fabric of money starts to unravel, and the tools we've come to rely on for stability, technology, markets, and artificial intelligence begin to accelerate the chaos instead of taming it. Stanley Druckenmiller, a legendary investor known for his uncanny ability to sense financial storms before they hit, warns that a global monetary crisis is looming, and AI could amplify its severity in ways few fully understand. He speaks not as a theorist, but from decades of navigating market upheavals, blending sharp economic insight with a visceral understanding of risk. As the landscape shifts faster than ever, his perspective challenges us to confront uncomfortable truths about our financial systems and the unforeseen consequences of emerging technologies. A global monetary crisis is imminent, and understanding why requires diving into the mechanics of the financial system that most people take for granted. Money, in its most essential form, is trust, a collective agreement that a piece of paper, a digital number, or a coin has value because we believe it does. Over the past decades, that trust has been propped up by central banks, governments, and markets working in tandem to manage liquidity, interest rates, and economic growth. But now cracks are forming, and those cracks are not subtle. They are deep, structural, and the kind that have historically presaged major financial upheaval. The warning signs are everywhere if you know where to look: asset prices divorced from economic fundamentals, record levels of sovereign and corporate debt, and a global monetary system that has become increasingly reliant on intervention rather than organic stability. Druckenmiller's insight stems from a career of observing these patterns up close, from the collapse of the bond market in the 1980s to the dot-com bubble in the 2008 financial crisis. What makes his warning particularly urgent is that history may not repeat exactly, but it rhymes, and the current conditions suggest a tune that is far more discordant than anything we've seen in recent memory. Central banks have wielded unprecedented power in recent years, flooding economies with liquidity to stave off recessions and prop up markets. These measures, while effective in the short term, have consequences that are often invisible until they become catastrophic. When interest rates remain artificially low for too long, risk-taking behavior escalates. Investors reach for yield in ways that make them blind to underlying risk. Governments borrow more than they can realistically sustain, and markets develop fragile dependencies on continuous intervention. This creates an environment where a small shock, an unexpected inflation spike, a geopolitical event, or even a technological disruption can cascade through the system like a line of dominoes. The fragility is compounded by the interconnectedness of global markets. A policy misstep in one country no longer remains isolated. It reverberates across continents, affecting currencies, bond yields, stock valuations, and commodity prices simultaneously. In such an environment, a crisis doesn't just happen in one place, it erupts everywhere, amplifying the damage and reducing the tools available to policymakers to respond effectively. Debt, both public and private, has reached historically unprecedented levels. Governments have relied on borrowing to fund deficits for years, confident that low interest rates would make repayment manageable. Corporations have done the same, issuing bonds and taking on leverage to finance expansion or stock buybacks. Even individuals have contributed to the buildup, leveraging themselves with mortgages, student loans, and credit in ways that assume continued economic stability. Druckenmiller emphasizes that this accumulation of debt is not sustainable indefinitely. When confidence erodes, when markets begin to question the ability of borrowers to meet obligations, the system can spiral rapidly. Debt that once seemed manageable becomes toxic, and liquidity that once flowed freely vanishes almost overnight. The combination of high debt and fragile market psychology has historically been the tinder for major monetary crises, and today, the conditions for ignition are increasingly present. Another factor amplifying the risk is the erosion of central bank credibility. For decades, institutions like the Federal Reserve, the European Central Bank, and the Bank of Japan have been seen as guardians of financial stability. Their interventions, whether through interest rate adjustments, quantitative easing, or emergency lending, have reassured markets and restored confidence during turbulence. However, repeated reliance on these tools can have diminishing returns. Markets may begin to interpret every policy move as a signal of desperation rather than control. When participants lose faith in the ability of central banks to manage the system effectively, panic replaces rational decision-making, and the slightest negative development can trigger outsized reactions. This loss of confidence is difficult to reverse, particularly in a globalized system where perceptions spread instantly through digital networks, social media, and 24-hour news cycles. Currency instability adds yet another layer of complexity. Major currencies like the dollar, euro, and yen serve not only as national tender but also as global reserves. Their stability underpins international trade, investment flows, and geopolitical influence. When confidence in a currency wavers, it can create a cascade of disruptions. Import costs soar, capital flees to perceived safe havens, and trade balances are thrown into chaos. Druckenmiller's perspective highlights that even if individual economies appear resilient, the global system is only as strong as its weakest link. A crisis triggered in one region can rapidly infect others, turning what might have been a localized problem into a worldwide financial storm. Finally, asset valuations themselves are signaling danger. Stock markets, real estate, and other investments have levels that seem detached from underlying economic realities. Investors continue to chase growth and returns, often ignoring warning signs and rational fundamentals. This divergence between price and value creates bubbles, pockets of extreme optimism that, when they burst, wipe out wealth and confidence at an unprecedented scale. History is full of examples, from the South Sea bubble to the 2008 housing collapse, where inflated asset prices masked systemic weaknesses until they could no longer be contained. Druckenmiller's warning is that we are approaching a similar inflection point, but with the added complication of modern financial technology, global interconnectedness, and AI-driven trading systems that can accelerate market movements beyond human control. Each of these factors, debt accumulation, fragile confidence in central banks, currency risks, and inflated asset prices, converges to create a perfect storm. The system is not just stressed, it is primed for a shock that could ripple across borders and industries, toppling institutions that have long been considered stable and reshaping the rules of the financial game. It is within this context that Druckenmiller's warning becomes more than just speculation. It is a call to understand the mechanisms at play, to observe the warning signs with rigor, and to recognize that the next crisis may arrive faster and with more ferocity than most anticipate. Inflation and debt levels are at unsustainable highs, creating a pressure cooker environment where even minor disruptions can ignite major financial upheaval. The rise of inflation over the past years has been subtle for some and alarming for others, but the underlying forces driving it are far more entrenched than most realize. It is not simply a matter of prices going up. It is the erosion of purchasing power, the invisible tax on savers, and the distortion of incentives across every level of the economy. When inflation climbs faster than wages, consumers feel the squeeze immediately, altering spending patterns and creating ripple effects that cascade through businesses dependent on predictable demand. At the same time, debt levels across governments, corporations, and individuals had surged to historically unprecedented heights, magnifying the consequences of inflation. High debt combined with rising prices creates a dual threat. Borrowers find themselves paying more to service obligations while the real value of the money they owe fluctuates unpredictably, destabilizing financial planning and market confidence. Central banks often attempt to tame inflation with interest rate adjustments, but when debt levels are extreme, the levers become double-edged swords. Raising rates to control price growth makes borrowing more expensive, potentially pushing heavily leveraged government companies toward default or restructuring. Conversely, keeping rates too low allows inflation to spiral unchecked, eroding trust in the currency itself. Druckenmiller has repeatedly pointed out that this balancing act is becoming nearly impossible in today's interconnected global economy. The very mechanisms designed to stabilize markets are now walking a razor's edge, and even small miscalculations could have cascading effects. Historical examples illustrate this peril. Hyperinflation in Weimar Germany and more recently in Venezuela were not sudden events, but the result of long-term imbalances in debt, currency supply, and confidence. The danger today is that these conditions are replicated across multiple major economies simultaneously, creating a global tinderbox where a single spark could trigger synchronized crises. Corporate debt has grown particularly alarming in this environment. Companies, enticed by historically low interest rates, have leveraged heavily to fund expansions, acquisitions, and stock buybacks. While this strategy can amplify conditions, it also leaves firms exceptionally vulnerable to any shift in market conditions, such as rising rates or tightening credit. When companies face higher costs of debt, reduced consumer demand, or disrupted supply chains, the consequences are immediate layoffs, bankruptcies, and defaults that ripple through banks, investors, and suppliers. Investors who have been lulled into complacency by years of low volatility may suddenly confront massive losses, further eroding market confidence. This cycle is precisely the type of scenario that Druckenmiller warns is imminent, where high debt levels and inflation intersect to create systemic instability rather than isolated disruptions. Government debt, meanwhile, has become a double-edged sword. Fiscal stimulus programs designed to prop up economies during crisis have left many nations with ballooning deficits, and the long-term cost of servicing that debt is rising alongside inflation. As central banks attempt to tighten monetary policy to rein in price increases, governments may find themselves caught between rising interest obligations and the need to maintain social programs and public investment. The resulting tension creates a dangerous feedback loop. Fiscal strain undermines confidence in government bonds, forcing yields higher, which further increases debt service costs, feeding into the cycle of instability. For investors, the stakes are profound. The safest assets in normal times, sovereign bonds, may no longer provide protection in a climate of inflation and rising debt, fundamentally altering tradition and strategies and risk assumptions. Household debt adds another layer of risk. Mortgages, student loans, credit cards, and other forms of personal borrowing have expanded as consumers took advantage of low interest rates and easy credit. Rising inflation eats into disposable income, while variable rate loans become more expensive, stretching household budgets to the breaking point. When millions of individuals simultaneously face these pressures, consumer spending, which drives a significant portion of economic activity, contracts sharply, creating a negative feedback loop that depresses corporate revenues and threatens employment. This interconnected web of debt and spending makes the system extraordinarily sensitive to shocks, where individual financial strain can aggregate into broader market instability. Another element exacerbating this danger is the global nature of debt. Governments, corporations, and banks are interconnected across borders through lending, investment, and trade. A debt crisis in one country can propagate rapidly through the global financial system, affecting currencies, stock markets, and interest rates elsewhere. This contagion effect was starkly evident during the European debt crisis of the early 2010s, but today, with debt levels far higher and financial systems more tightly coupled, the potential impact is far greater. Druckenmiller's warning highlights that the combination of high inflation and record debt is not just a domestic issue, it is a global threat, with vulnerabilities in one region capable of triggering cascading failures worldwide. Asset markets are also feeling the tension between inflation and debt. Equities, real estate, and bonds are all influenced by expectations about interest rates, currency stability, and economic growth. When inflation rises, central banks react, borrowing costs increase, and asset valuations adjust, often violently. Highly leveraged assets are particularly vulnerable, as their value can swing dramatically in response to small changes in interest rates or economic forecasts. For those who have grown accustomed to steady returns and predictable markets, the intersection of rising inflation and mounting debt introduces a level of volatility that can quickly overwhelm conventional risk management strategies. The combination of inflation and debt at extreme levels sets the stage for a financial environment that is both volatile and unpredictable. Each factor alone poses serious challenges, but together they create a system where small shocks can trigger massive consequences, where confidence erodes faster than policymakers can react, and where the safety nets of traditional finance may no longer hold. In this context, understanding the dynamics between debt and inflation is not an academic exercise. It is a matter of survival for investors, businesses, and economies alike. Central banks may struggle to stabilize markets, and the challenges they face today are unlike anything seen in modern economic history. For decades, these institutions have operated on a relatively straightforward playbook: adjust interest rates, provide liquidity when needed, and communicate policy clearly to maintain market confidence. These tools worked effectively in predictable cycles of growth and recession, allowing central banks to steer economies with a high degree of precision. However, the current landscape is fundamentally different. Debt levels are historically high, inflation is persistent, global interconnectedness amplifies shocks, and technological innovations such as AI-driven trading introduce new forms of volatility that operate at speeds far beyond human comprehension. In such an environment, the levers that central banks have traditionally relied upon are no longer as effective or predictable, making their task of stabilization extraordinarily complex and precarious. The first major obstacle is the sheer scale of debt that dominates the global economy. Governments, corporations, and households alike are carrying unprecedented liabilities, which makes the system incredibly sensitive to changes in interest rates. When central banks attempt to tighten monetary policy to control inflation or cool overheated markets, the cost of servicing debt increases, creating stress for borrowers across all sectors. Highly leveraged institutions can falter under this pressure, triggering defaults, bankruptcies, and a chain reaction that spreads rapidly through the financial system. In past crises, central banks could rely on conventional rate adjustments and liquidity injections to restore confidence. But with debt so pervasive and interconnected, even small policy moves carry the potential for disproportionate consequences. Druckenmiller emphasizes that the tools of yesterday may be insufficient today, and the margin for error has narrowed to almost nothing. Globalization adds another layer of difficulty for central banks. In a world where capital flows instantaneously across borders, policy decisions in one country can have immediate, far-reaching impacts elsewhere. A rate hike by the Federal Reserve, for example, affects not only the U.S. economy but also emerging markets dependent on dollar-denominated debt. Currency fluctuations, capital flight, and cross-border market reactions can undermine the intended effect of domestic policy, leaving central banks grappling with unintended consequences that spread unpredictably. This interdependence means that no central bank can operate in isolation. Coordination becomes essential, yet coordination is difficult when nations face differing domestic pressures, political constraints, and economic priorities. The resulting environment is one in which stabilizing one part of the system can inadvertently destabilize another, a problem that grows more acute as debt and leverage continue to rise worldwide. Technology has also transformed the speed and nature of market reactions. High-frequency trading algorithms, AI-driven investment strategies, and real-time global communications mean that financial markets respond to news, policy announcements, and economic data almost instantaneously. While this can improve efficiency under normal conditions, it also amplifies volatility during periods of stress. Central banks now operate in a world where a policy misstep or a misinterpreted statement can trigger cascading reactions in milliseconds, well before human intervention can meaningfully adjust market behavior. The combination of automated trading and highly leveraged positions creates the potential for flash crashes, sudden liquidity shortages, and abrupt shifts in asset valuations, all of which complicate the central bank's task of maintaining stability. Furthermore, the credibility of central banks is under scrutiny in a way it has not been in decades. For years, markets have assumed that these institutions will act decisively to prevent systemic crises. But the repeated use of unconventional tools, such as quantitative easing and prolonged low interest rates, has stretched credibility thin. Investors are increasingly aware that central banks are navigating uncharted territory, and this awareness can undermine confidence. When market participants doubt the effectiveness of central bank actions, their reactions can magnify instability rather than contain it. Druckenmiller warns that the erosion of trust is particularly dangerous because monetary stability relies as much on perception as on policy. A loss of confidence can trigger self-fulfilling cycles of panic and disruption. Central banks also face political constraints that limit their maneuverability. Policymakers operate in a world of competing interests, where fiscal pressures, social obligations, and electoral considerations can conflict with the technical requirements of monetary stabilization. Attempts to tighten policy to control inflation may provoke political backlash or social unrest, while too much intervention can raise concerns about moral hazard or long-term economic distortion. Balancing these competing pressures requires not only technical expertise, but also political dexterity. Yet history shows that politics often interferes with timely, decisive action. In an era of hyper-connected media and global scrutiny, missteps are magnified, and central banks must contend with both the technical complexity of their decisions and the political consequences of those decisions. Liquidity management presents another profound challenge. In theory, central banks can inject money into the system to stabilize markets. But when debt levels are extreme and market participants are highly leveraged, even substantial liquidity injections may be insufficient. The effectiveness of traditional tools diminishes as markets become more complex and interdependent, and unconventional measures may be required. However, unconventional tools often carry unintended consequences that ripple through the system, creating new vulnerabilities even as they attempt to resolve old ones. The balance between intervention and restraint becomes increasingly delicate, and the margin for error shrinks with every additional layer of complexity. Finally, the psychological dimension cannot be underestimated. Central banks depend on the expectations of investors, businesses, and consumers to guide behavior. Confidence drives lending, investment, and consumption, and without it, markets can spiral out of control regardless of policy measures. In today's environment, where debt, inflation, and global interconnectedness create heightened sensitivity, maintaining confidence is extraordinarily difficult. Any perception of indecision, incompetence, or inconsistency can trigger rapid and destabilizing reactions across markets, compounding the very crisis that central banks aim to prevent. Druckenmiller's caution underscores central banks are navigating an environment where both the technical challenges of policy and the fragile psychology of confidence must be managed simultaneously, an undertaking more formidable than any point in recent history. AI could accelerate financial instability, adding an entirely new dimension to an already precarious system. Financial markets have always been influenced by human psychology, institutional behavior, and macroeconomic forces, but artificial intelligence introduces a level of speed, complexity, and opacity that humans can barely comprehend. Trading algorithms now make millions of decisions in milliseconds, reacting to market signals, news, and even social media sentiment faster than any human could process. While AI can increase efficiency and liquidity under normal conditions, it also has the potential to amplify shocks, propagate errors, and create feedback loops that accelerate market volatility to unprecedented levels. Druckenmiller's warnings highlight that the integration of AI into finance is not just a marginal factor, it is a systemic risk multiplier, capable of transforming ordinary fluctuations into full-blown crises. The first mechanism through which AI can destabilize markets is its ability to synchronize actions across vast networks of assets. Machine learning algorithms are often trained on similar datasets and optimized using similar objectives, such as maximizing short-term returns or minimizing perceived risk. When market conditions shift unexpectedly, these systems can react in unison, selling assets, reducing exposure, or relocating capital simultaneously. This synchronized behavior can create cascading price movements that far exceed what human actors alone would produce. For example, A sudden drop in bond yields or a shift in equity valuations could trigger algorithmic sell-offs across multiple markets in milliseconds, creating liquidity shortages and amplifying panic. In a highly leveraged system already stressed by debt and inflation, such rapid, automated reactions could trans systemic disruptions. AI also changes the speed at which information influences markets. News, economic data, geopolitical events, and even rumors are now processed and acted upon instantly by trading systems. Human traders and institutional decision makers are forced to respond in near real time or risk falling behind, creating a feedback loop where AI not only reacts to markets but shapes them. In normal conditions, this might improve efficiency, but during periods of stress, it can magnify volatility. Minor misinterpretations of economic signals or algorithmic errors can trigger outsized reactions, and the speed of these responses leaves little room for human intervention to stabilize the system. Druckenmiller emphasizes that when markets move faster than policymakers and human traders can respond, the traditional stabilizing mechanisms, such as central bank interventions or circuit breakers, may no longer suffice. Another concern is the opacity of AI decision-making. Machine learning models often operate as black boxes, with their internal logic and weighting of inputs difficult to interpret even for their creators. When these models interact in complex financial networks, predicting outcomes becomes extremely challenging. Errors, biases, or unintended interactions can propagate in unpredictable ways. Unlike traditional financial instruments, where risk can be modeled and managed with historical data, AI-driven systems introduce novel, emergent behaviors that defy conventional risk assessment. This unpredictability makes it harder for regulators, investors, and institutions to anticipate crises before they unfold, increasing the likelihood of sudden, unmanageable shocks. AI can also exacerbate leverage and risk-taking behaviors. Automated systems are capable of executing highly complex strategies that humans cannot manage manually, including derivatives trades, high-frequency arbitrage, and asset hedging. While these strategies can be profitable, they also magnify exposure to systemic shocks. When multiple AI systems employ similar strategies or respond to the same market signals, the result can be concentrated risk across the financial system. Druckenmiller has long emphasized that high leverage amplifies every movement in the markets, and AI's ability to execute highly leveraged trades at lightning speed means that even minor miscalculations can cascade rapidly, threatening broader stability. Markey is another mention where AI can amplify instability. Social media sentiment analysis, news scraping, and predictive models can influence not only trading algorithms but also human decision-making. Investors often follow signals from algorithms without fully understanding their underlying logic, creating herding behavior that magnifies market swings. When multiple participants, both human and AI, act in concert based on similar predictive cues, the market can overreact to news or rumors, generating volatility that would not exist in a purely human-driven system. This dynamic makes it increasingly difficult for central banks and regulators to gauge true market sentiment or to deploy traditional stabilization tools effectively. AI also interacts with the fragility of the global financial system, where high debt levels, stretched valuations, and interconnected markets already create conditions for rapid contagion. In such a system, algorithmic responses can transmit shocks across borders instantly. A sudden sell-off in one market can trigger automated reactions in another, creating a chain reaction that spreads faster than human actors or policy interventions can respond. This global propagation effect increases systemic risk, turning what might have been a localized disruption into a worldwide financial event. Finally, the rise of AI creates challenges for regulatory oversight and intervention. Traditional financial regulations are designed for human-driven systems with observable behaviors and predictable responses. AI, by contrast, evolves dynamically, adapts to changing conditions, and can operate in ways that evade conventional monitoring. Regulators may struggle to detect systemic risk in real time, and by the time a problem is identified, automated systems may have already amplified its impact. Druckenmiller's caution underscores that the very tools designed to enhance efficiency and profit, AI-driven trading, predictive analytics, and algorithmic risk management, can paradoxically accelerate instability, making the next financial crisis not only more likely, but potentially faster and more severe than any in history. Market volatility will increase dramatically, and the scale and speed of that volatility may exceed anything investors have experienced in recent decades. Historically, volatility was often to identifiable economic or political events, a recession, a sudden policy change, or a geopolitical conflict. These events, while disruptive, unfolded over days, weeks, or months, giving market participants and policymakers time to respond, recalibrate, and mitigate damage. Today, the situation is profoundly different. The convergence of historically high debt levels, persistent inflation, global interconnectedness, AI-driven trading, and leveraged financial positions creates a perfect storm where small shocks can explode into rapid, system-wide turbulence. Druckenmiller emphasizes that this is not hypothetical speculation. It is a structural transformation of the market environment, one in which volatility is no longer a temporary phenomenon, but a persistent, high-frequency condition. One of the primary drivers of this volatility is the feedback loop between debt and interest rates. Governments, corporations, and households are highly leveraged, and even minor adjustments in rates or shifts in market sentiment can trigger outsized reactions. When interest rates rise to combat inflation or stabilize currencies, debt service costs increase, which can lead to defaults, cutbacks, or distressed asset sales. These actions in turn ripple through the broader financial system, affecting equity prices, bond yields, and currency valuations almost instantaneously. Investors seeing these rapid shifts often react preemptively, creating a self-reinforcing cycle where volatility feeds on itself. In such an environment, traditional assumptions about risk, correlation, and diversification become unreliable, challenging even seasoned professionals to anticipate market movements accurately. Another factor driving volatility is the increasing role of algorithmic and AI-driven trading systems. These technologies can exit trades in milliseconds based on complex models that react to a wide range of inputs, from economic data to social media sentiment. Under normal conditions, these systems provide liquidity and efficiency, but in times of stress, they can amplify price swings. A sudden drop in one market can trigger algorithmic sell-offs across multiple asset classes, creating cascading effects that human traders cannot counteract in real time. This phenomenon has already been observed in flash crashes, where markets plunged and rebounded within minutes, but the stakes today are far higher because leverage, debt, and interconnectedness multiply the potential impact. Druckenmiller warns that as AI and algorithms continue to dominate trading, market moves may become less rational, less predictable, and more violent. Geopolitical uncertainty adds yet another layer of volatility. Conflicts, sanctions, trade disputes, and political instability have always affected markets, but the interconnectedness of today's financial system means these events can trigger far-reaching consequences almost instantly. A disruption in one region can impact commodity prices, currency values, and international trade, forcing rapid adjustments in portfolios across continents. Investors accustomed to more predictable cycles may find themselves blindsided by sudden, large-scale market reactions, and policymakers may struggle to respond effectively. In this context, volatility is no longer just a financial metric. It becomes a measure of systemic fragility, reflecting the tight coupling of multiple risks that can erupt simultaneously. Investor psychology plays a central role in amplifying market volatility. Fear and greed, the timeless drivers of market behavior, are intensified in a system where news spreads instantaneously. AI predicts sentiment, and leveraged positions can magnify gains or losses within minutes. Social media, financial news, and real-time analytics create an environment where market participants feel compelled to react immediately, often amplifying trends rather than counterbalancing them. Herding behavior becomes pronounced, and small shocks can trigger outsized moves as investors rush to exit positions or chase momentum. This feedback loop between human behavior and machine-driven responses contributes to an environment where volatility is continuous, unpredictable, and potentially self-perpetuating. Liquidity constraints further exacerbate the problem. While markets generally appear liquid in calm conditions, extreme stress can reveal hidden vulnerabilities. Highly leveraged positions, margin calls, and concentrated exposures can force rapid unwinding of trades, creating sudden spikes in volatility. When multiple participants attempt to exit simultaneously, markets can experience extreme price swings, flash crashes, or gaps that persist until interventions occur. The combination of structural fragility, high leverage, and AI-driven trading makes such events more likely, faster, and potentially more severe than past market disruptions. Druckenmiller highlights that understanding these dynamics is crucial for anticipating not just isolated shocks, but sustained periods of turbulence that ripple across asset classes. Global interdependence amplifies volatility further. Financial markets are no longer confined to national borders. They are deeply linked through trade, investment, and currency flows. A crisis in one major economy can propagate rapidly through international markets, triggering synchronized volatility across multiple regions. For example, a sharp currency depreciation in one country can affect commodity prices globally, strain emerging market debt, and force central banks elsewhere to adjust policy in ways that create further uncertainty. This interconnectedness means that volatility is no longer a localized phenomenon, it is systemic, capable of cascading across continents in a matter of hours or even minutes. Finally, the combination of extreme leverage, AI-driven trading, and systemic fragility means that volatility may not just be higher, it may also be more erratic and less predictable. Traditional risk management tools, historical correlations, and diversification strategies may fail under conditions where small shocks propagate rapidly, feedback loops dominate, and investor sentiment shifts abruptly. In this environment, market participants must navigate a landscape where rapid swings are the norm, not the exception, and where volatility itself becomes a central determinant of financial stability, strategy, and survival. Investors need to prepare for systemic shocks, because the financial landscape today is a pressure cooker where seemingly minor events can trigger cascading consequences across the global economy. Preparation is no longer just about picking safe assets or diversifying across sectors. It requires a deep understanding of structural vulnerabilities, the interplay between debt, inflation, and central bank policies, and the rapid dynamics introduced by technology and AI. Druckenmiller's warning is stark: those who remain complacent, assuming that traditional strategies or historical patterns will protect them, are exposing themselves to unprecedented risk. The era of slow, predictable cycles has ended, replaced by a hyperconnected, high-speed financial system where shocks propagate faster and with greater intensity than ever before. The first step in preparing for systemic shocks is recognizing the fragility embedded in today's markets. Debt levels, both public and private, are historically high, leaving borrowers highly sensitive to interest rate changes, inflation spikes, or disruptions in liquidity. Highly leveraged corporations, governments, and households are all vulnerable to shifts that might have been manageable in a less leveraged system. Investors must identify concentrations of risk in their portfolios, including exposure to sectors or markets that are most sensitive to interest rate fluctuations, currency volatility, or sudden liquidity withdrawals. Understanding these dependencies is critical because during a systemic shock, correlations that appeared stable in calm markets can break down completely, leading to simultaneous losses across multiple asset classes. Diversification remains important, but it must be applied with nuance. Traditional approaches that rely on spreading investments across equities, bonds, and real estate may not provide adequate protection when systemic risk affects all markets simultaneously. Investors must consider alternative strategies, including uncorrelated assets, hedging instruments, and exposure to safe havens such as high-quality sovereign debt or gold. Even these measures are not foolproof, as global shocks can affect traditionally safe assets, But a well-structured approach can reduce vulnerability and provide liquidity when markets are under pressure. Druckenmiller emphasizes that preparation is not about avoiding risk entirely. It is about managing it intelligently and positioning oneself to survive and even benefit during periods of extreme disruption. Liquidity management is another crucial component. In times of systemic stress, the ability to access cash or liquid assets quickly can mean the difference between weathering a crisis and being forced into fire sales. Investors must assess the liquidity of their holdings and ensure that a portion of their portfolio can be converted into cash without significant loss, even under adverse market conditions. This requires anticipating scenarios where markets may become illiquid, margin calls may intensify, and leverage positions could be unwound rapidly. Being able to respond with agility during such moments is essential, as opportunities and risks unfold simultaneously, often at breathtaking speed. Stress testing and scenario planning are invaluable tools for anticipating systemic shocks. Investors should model extreme but plausible scenarios, such as a sudden spike in inflation, a central bank policy misstep, a geopolitical conflict, or a market-driven cascade triggered by AI trading algorithms. By understanding how these events could affect portfolios, investors can identify weaknesses, adjust exposures, and develop contingency plans. This approach transforms preparation from reactive measures into proactive strategy, enabling investors to navigate turbulent conditions with greater clarity and confidence. Druckenmiller's insight highlights that those who fail to anticipate extreme events are often the ones most severely impacted, as they are forced to make decisions under duress rather than from a position of foresight. Understanding the psychological dimension of systemic shocks is equally critical. Fear, panic, and herd behavior can amplify market disruptions far beyond what fundamentals would suggest. Investors who remain calm and rational during periods of extreme volatility are better positioned to avoid reactive mistakes, such as selling at the bottom or over-leveraging during spikes. Discipline, patience, and a clear strategy rooted in risk management become as important as technical analysis or market knowledge. The ability to maintain composure, stick to a plan, and act strategically under pressure can determine not only survival but also long-term success. Global interconnectivity further complicates preparation, as systemic shocks rarely remain localized. A debt crisis, currency devaluation, or liquidity squeeze in one region can quickly ripple through international markets, affecting assets and investments worldwide. Investors must consider exposure to global risk factors and understand how shocks in one part of the world may propagate through currencies, commodities, bonds, and equities. Else these global interdependencies, through both financial instruments and diversified geographic exposure, becomes critical in reducing vulnerability to contagion effects. Technology and AI introduce a final layer of complexity. Automated trading, algorithmic strategies, and predictive models can accelerate market moves far beyond human reaction times. While these tools offer opportunities, they also magnify the speed and unpredictability of systemic shocks. Investors must recognize that traditional methods of monitoring risk, assessing fundamentals, or reacting news may be insufficient in an environment where AI-driven systems dominate trading decisions. Incorporating an understanding of technological impacts, market automation, and algorithmic behavior into risk management strategies is essential for navigating this new reality. Ultimately, preparing for systemic shocks is not about fear, it is about awareness, foresight, and adaptability. Investors must recognize the fragility and complexity of today's financial system, understand the forces driving volatility, and take proactive steps to manage risk. This includes evaluating debt exposure, diversifying intelligently, maintaining liquidity, stress testing portfolios, considering psychological factors, accounting for global interconnections, and integrating the realities of AI-driven markets. Druckenmiller's guidance underscores that the ability to survive and potentially thrive during systemic shocks depends on preparation, discipline, and a willingness to confront uncomfortable truths about the fragility of modern markets.